If you are a stockholder in the United States or anywhere else that offers the chance to purchase United States listed market equities, you notice that you might be able to purchase not only the stocks from companies in the United States, but also those in China. Here we will take a look at one major and potentially dangerous difference that has to do with Chinese companies publicly listed in America. In America, a company is structured as a legal entity that issues shares onto a stock market. And anybody can go and buy shares and stocks in companies like Apple with the knowledge that they are buying a portion of the company. A company that exists within the United States and owns property in the United States. If the company were to ever come to dire straits, you as a shareholder could take comfort in the fact that you have claim on the USA domiciled assets of the company, as well as a court in the United States will be backing your claim. You might not ever actually benefit if you do not own enough shares, meaning enough shares to hire a law firm and go to court, but at least there is that theoretical comfort. That is what is happening to Venezuela. They own an oil company in the US called Citgo, and that company's US domiciled assets and cash flows are likely to be seized by creditors as directed by the courts. On the surface, it seems like many of China's publicly listed companies work in the same way. The average investor with a stock brokerage can log in onto Fidelity or Scottrade or whatever and purchase shares in Alibaba, Netease, or Baidu. But if you were to look at it carefully, you would find that you are not buying shares in a Chinese company. Instead, you're buying shares in a Cayman Islands shell company that has the same name as Alibaba, NetEase, and Baidu. This might be a little confusing. After all, aren't you buying into a Chinese company? The reality is, such a structure has no point in this world except to dodge regulations, that of the Chinese government. The Chinese government imposes restrictions on foreign ownership of companies operating in certain industries, including the internet. But in order to IPO a company, you technically have to give up ownership to the buyers. Thus, they create something called a VIE structure. VIE stands for Variable Interest Entity. When a Chinese internet company like Alibaba wants to go public outside of China, they get around the foreign ownership restriction by first creating a shell company in the British Virgin Islands or the Cayman Islands. At the same time, they create an operating company within China itself. This is what is actually doing business in China, the one that owns the Alibaba license and Chinese assets, and the ones that Chinese consumers would be giving money to. Foreigners can own shares in the Cayman Islands company, but not in the Chinese operating company. So, the Chinese shareholders create a contractual link between the two companies. It is not like owning shares, but just a contract to get profits and dividends from the operating company to the Cayman Islands shell company. Now, the shell company is ready to go public. They sell the shares in the USA and make hopefully billions. Then the IPO money is transferred to the Chinese operating company through loans. This arrangement is unusual and so causes a lot of concern, because actual stock control does not actually belong to the public shareholders, but to the owner of the Chinese operating company. So the Chinese shareholders can do whatever they want without needing to consult public shareholders, who, if it was all in a normal arrangement, would get some sort of consultation. The most famous incident of this nature happened with Alibaba when co-founder Jack Ma transferred ownership of the company's prize payment service, Alipay, away from the company into his own personal holdings, depriving the shareholders of a crown jewel. So China is clearly aware of this practice. Alibaba, after all, is one of the biggest privately owned companies in the country, and its $14 billion IPO is the biggest in history. So why hasn't the Chinese government done anything about it? The obvious answer has to do with money. By keeping this loophole open, the government gets the benefits from foreign money and foreign direct investment, while holding the option, more like a sword over people's head, to roll it back if necessary. But over time, the party has turned away from the West and is no longer so friendly to foreign money. Today, one of China's most important companies, Tencent, which runs the all-important chat app WeChat, is 30% owned by a South African company who made their investment back in the early 2000s. No way that such an important part of the internet can be owned by a foreigner if it was today. The shell company representing Alibaba Group is now valued at $400 billion. It is hard to imagine that it can one day vanish without a trace and leave millions of American shareholders financially ruined. But it is a very real risk. That being said, it seems like the apocalyptic outcome is least likely. For more information, we can look back to a leaked 2011 report by China's equivalent of the SEC, the CSRC. This report was delivered to law firms in 2011, and other than a random mention in 2015, is the only semi-official comment by the Chinese government about what it wants to do with the VIE loophole. And it's pretty sensible, actually. It's pretty sensible about the whole thing. In it, it proposes a carrot and stick approach. Companies will, from a certain point in time, no longer be allowed to go public in the United States or outside of China using the VIE structure, and it will remove the Chinese tax loopholes around that structure, which made it super profitable for everyone to do it. In effect, it is going to get banned. But companies who have already gone public using that structure, which includes about 40% of all Chinese companies on the US market today, get grandfathered in. That's the stick. For the carrot, the government will make it easier for Chinese companies to IPO their companies in Chinese stock markets like the Shanghai and Shenzhen stock markets, which have a higher valuation, which likely would mean that they would get much more money for their IPO. China so far seems to be taking this plan proposal as a to-do list and are executing on it thus far. So perhaps in a decade or two, we can look back on the structure and see it more like an interesting quirk of history rather than the economy ruining nuclear time bomb that some skeptics say it is.